You've probably heard people talk about trading as this path to, incredible wealth. But the reality is, um, so few people actually make money consistently.
Right. They often throw around that stat, don't they? Like 95% of traders fail.
Exactly. And it's usually not because they aren't smart or they don't have good strategies. So what is the secret sauce?
Well, that's what we're diving into today. We're looking at a really illuminating perspective, one that kind of turns conventional wisdom on its head. It's from Mark Douglas's book, Trading in the Zone.
Ah, a classic. So our mission here is basically to explore why being good at trading seems to have less to do with, say, market analysis or finding the perfect system.
And everything to do with developing a pretty unique psychological mindset.
Yeah.
We're going to try and unpack the core mental shifts you need to make to really transform your whole approach, moving from that cycle of frustration to hopefully consistent success.
And it's about understanding how the top traders think,
Right.
not just what they do. So if you've ever felt just overwhelmed by all the market information out there, or that gap between what you know you should do and what you actually do when you're in a trade.
Or struggled with that fear, that hesitation when real money's on the line.
Yeah, that feeling. This deep dive is definitely for you. We're going to show you why some of the skills that make you really successful in, normal life can actually work against you in trading.
And how to cultivate that counterintuitive mindset, the one that consistently profitable traders seem to have.
Okay, so where do we start? Maybe with how trading thinking has evolved.
Good idea. Let's rewind a bit. Back in, say, the 1970s, fundamental analysis was really the main game in town.
Right. And fundamental analysis, just quickly, is trying to predict price based on, well, everything relevant, isn't it? Interest rates, company balance sheets, maybe even the weather for commodities.
Exactly. All those external factors. And it sounds super logical. Like if you just gather enough data points, you should be able to figure it out.
But there was a flaw, a big one.
A huge one. It rarely, if ever, properly accounted for people. People are the ones actually clicking buy or sell, often driven by emotions, by things that aren't strictly rational, not just mathematical models.
Ah, okay, so that creates what Douglas calls the reality gap.
That's the term, yeah. The gap between what the fundamentals say should happen and what the price actually is doing. You could be spot on fundamentally for the long term, but the short-term price swings driven by people could just wipe you out.
I see. That's a serious problem for a trader. So this gap sort of paved the way for technical analysis.
It did. Traders started noticing that people, when they act together in markets, tend to create behavior patterns. And these patterns, well, they tend to repeat with some statistical reliability.
So technical analysis is basically organizing that collective behavior, looking for identifiable patterns to anticipate what might happen next based on what happened before.
You got it. It's looking at what the market is doing now in relation to what it has done in the past. It effectively closed that old reality gap because it focused on price action itself.
And that opened up way more perceived opportunities, right?
Yeah.
Because these patterns show up on all different time frames.
Absolutely. From minute-to-minute charts right up to yearly ones, opportunities seemed almost unlimited.
Okay, but here's the twist Douglas brings in, the real kicker. If technical analysis is so useful and people are getting better at spotting these patterns, why do so many smart traders still struggle to make money consistently?
The million-dollar question.
It suggests it's not just about what you see on the chart. Douglas points to a psychological gap.
Exactly. The gap between understanding the market patterns and actually consistently profiting from them. That's the counterintuitive bit.
This is where mental analysis comes in then.
This is it, the ultimate shift. The crucial insight here is that the consistent winners, they don't just know more stuff. They actually think differently, fundamentally differently from everyone else.
And that's what we're focusing on, how they think.
That's the plan. Not just the tools they use, but the mental framework behind it all.
Okay, let's talk about the appeal of trading, because it offers this incredible sense of, limitless opportunity and complete freedom, doesn't it?
Absolutely. Nothing happens until you decide. You pull the trigger. A trade lasts as long as you want it to. It ends when you close it. No boss, no set hours, no external rules dictating your actions.
Sounds like the ultimate dream job on paper.
It really does. But it's exactly that allure, that completely unrestricted environment that creates some really deep psychological challenges that, frankly, most people are just not ready for.
It requires some serious mental adjustments, as Douglas puts it.
Big time. Think about it. We grow up in societies that are, pretty structured. Lots of rules, boundaries, expectations. This often clashes with our natural curiosity, or sort of inner directed forces or passions.
Like that classic childhood thing. No, don't touch that. You hear that enough.
Right. And Douglas argues those denied impulses, when our natural urges get shut down, they create unreconciled emotional energy. It's like this backlog of suppressed stuff.
And that can create deep-seated resistance later on, which then plays out in trading.
Exactly. And that resistance becomes a massive problem because the market, unlike society, gives you zero external rules or boundaries. No safety nets, no one to stop you.
It's blunt, isn't it? Douglas says it will take everything you own and more if you don't build your own internal structure.
He doesn't mince words. And this freedom, this lack of external structure, it sets up these psychological traps. Douglas highlights 4 big ones.
Okay, let's break them down. What's the first trap?
The first one is surprisingly subtle. It's our unwillingness to even create rules for ourselves because we spend our lives resisting rules imposed on us.
We subconsciously resist creating our own rules, even when they're for our own good.
Bingo. It takes, as he says, often a great deal of pain and suffering, usually meaning financial pain, to finally overcome that ingrained resistance and accept the need for self-imposed discipline in trading.
Wow. Okay, so that resistance leads into the next one.
It often does. Problem number 2, failure to take responsibility. Trading is, at its core, a pure, unencumbered personal choice. Every single click.
But it's so easy to blame the market, isn't it? Especially when things go wrong unexpectedly.
It's the default reaction for many, and if you trade randomly without a clear plan or edge, it makes it even easier to blame external factors. The market was crazy today, rather than owning the fact that maybe your approach wasn't sound.
Okay, that makes sense. What's trap number 3?
This one's insidious. Addiction to random rewards. Remember those studies with monkeys or even just playing a slot machine?
Yeah, the random unexpected wins are the most powerful.
Exactly. Humans get this euphoria-inducing chemical hit from unexpected wins. It makes us prone to chasing that feeling, chasing random rewards, even if it means ignoring our own rules or proper risk management.
You enter a state of choicelessness, Douglas calls it, just chasing the next hit.
Pretty much. You forget the plan, you forget the risk, you just want that winning feeling again. It's like we're biologically wired to sabotage ourselves here.
Scary. Okay, and the fourth problem.
External versus internal control. In life, in society, we learn to negotiate, persuade, maybe even manipulate our environment and other people to get what we want.
Right, we try to exert control outwardly.
But the market, Douglas calls it a psychological wilderness. It does not know, care, or respond to anything that is important to us. It doesn't care about your needs, your wants, your reasons.
So trying to control it is futile.
Completely. The only thing you can actually control in trading is yourself, your perception, and your behavior. The market just does what it does.
That's a massive realization. And it leads right into the cornerstone of success, Douglas emphasizes. Taking absolute responsibility.
Complete and absolute responsibility. For every single outcome, win or lose, it's a level of personal ownership that most people, frankly, haven't ever needed to develop before they start trading.
It sounds almost crushing, especially after a bad run. How do you even start doing that without just beating yourself up?
It's a huge paradigm shift. It's not about blame. Elite traders, the ones operating in the zone, they have what Douglas calls a carefree state of mind.
Like athletes in the zone.
Exactly. They act instinctively without fear of making mistakes because they've basically eliminated the effects of fear and recklessness from their trading. They accept the outcome, whatever it is, as feedback, as information, not as a personal judgment.
So defining that winning attitude, what does it look like?
Douglas defines it beautifully. Expecting a positive result from your efforts with an acceptance that whatever results you get are a perfect reflection of your level of development and what you need to learn to do better.
Okay, so it's expecting to win, but accepting any outcome as just data, information about where you are right now.
Precisely. It decouples the outcome from your self-worth.
That contrasts sharply with how most people react to a loss, right?
Yeah.
The blame game.
Oh yeah. Most traders instinctively blame the market. They feel betrayed, like the market did something to them. Douglas suggests this often links back to childhood, when external forces caused us pain and we felt powerless.
But the market isn't a person. It isn't acting against you personally.
Not at all. It's a zero-sum environment. Its sole purpose, in a sense, is to extract money or opportunity from you. It doesn't owe you a thing. Blaming it just sets up this adversarial relationship which actually cuts you off from seeing the opportunities it presents.
And it's a dangerous trap to think that just learning more analysis will fix these internal issues.
Absolutely. If the problem is psychological, more market knowledge might just give you more sophisticated ways to avoid taking responsibility, to avoid risk. You end up creating the very losses you're trying to analyze your way out of.
It's a vicious cycle.
It really is. And that's why, as Douglas points out, leaving money on the table can sometimes feel even worse than taking a planned loss. Because when you take a loss, according to your plan, okay, you can still maybe grumble about the market, but when the market does exactly what you predicted, and you freeze or get out too early and leave huge profits behind, you can't blame the market then.
Ouch. It starkly highlights your inability to act appropriately.
Yeah.
Your fear, your hesitation.
Exactly. There's nowhere else to point the finger. It's incredibly uncomfortable, but also incredibly revealing about your internal state.
So the market is like a mirror then.
A perfect mirror. If you're feeling confident, calm, focused, it's likely because your internal beliefs are aligned for learning and executing your edge. If you're feeling angry, fearful, frustrated, it's probably because you fundamentally believe the market creates your emotional state and your results.
Stop fighting the
And
market.
stop fighting yourself. That's the core message.
Okay, this leads us into perception and beliefs. This is where it gets really mind-bending.
Mm.
Douglas says market information itself is neutral.
Totally neutral. Hard to believe sometimes, but yeah. The market doesn't generate happy information or painful information. It just generates information. Price ticks up, price ticks down, volume increases, volume decreases.
It's our mental framework that assigns the emotional charge, that decides if it's good news or bad news.
Precisely. It's like we're debugging our mental software, as he puts it. Our memories, the distinctions we've learned to make, our core beliefs, they exist as actual structured energy in our minds.
The true energy. Okay.
Think of it like this. That internal energy acts as a force, and it actually limits what you even perceive from the environment. If you haven't learned something yet, or if incoming information clashes violently with a deeply held belief.
Like it's invisible. You literally don't see it.
Literally invisible, yes. Think about the very first time you ever looked at a price chart. It was probably just, a bunch of confusing lines.
Really. Meaningless squiggles.
Right. But now, presumably, you see patterns, support, resistance, potential opportunities. The raw data hasn't changed, but your internal mental framework, your beliefs and distinctions has expanded. You can perceive more.
Like when you buy a specific model of car, and suddenly you see that car everywhere on the road. They were always there.
Exactly. Your perception filter changed.
Okay, and our minds automatically link things, right? Like association.
Hardwired for it. Our minds automatically connect current external information to similar stuff stored internally, memories, beliefs. And crucially, this often triggers an immediate emotional response based on the past association, not the present reality.
He uses the dog bite analogy, doesn't he?
Yeah, it's a great one. A child gets bitten by one specific dog, but then their mind automatically associates any dog they see later with that initial painful, frightening memory.
So they become afraid of all dogs, even
Well.
friendly ones. The fear feels absolutely real, generated by the dog in front of them.
But it's actually self-generated, triggered by the internal association with the past trauma. Yet, in that moment, it feels like absolute, unquestionable truth that this dog is dangerous.
And the parallel to trading is pretty direct.
Painfully direct. You take a loss, or a series of losses, then the next time a similar setup appears, even if it perfectly fits your edge, your mind instantly associates this now moment opportunity with the pain of the past losses.
And boom, fear kicks in. Hesitation, you second-guess yourself, you miss the entry, or jump out too soon.
All those classic trading errors, they often stem directly from this automatic fear-based association overriding your rational analysis. The fear feels like it's coming from the market, but it's generated internally.
So how on earth do we break that cycle? How do we trade without that fear, or its opposite, reckless overconfidence after a win?
This is where Douglas introduces what he considers the trader's ultimate edge, the core belief, the uncertainty principle.
Okay, sounds important. What is it?
It's cultivating a strong, virtually unshakable belief in an uncertain outcome with an edge in your favor. Let me repeat that. An uncertain outcome, but with a statistical edge over time.
A belief in uncertainty. That sounds paradoxical.
It does, but it's incredibly powerful. This belief acts as a buffer. It prevents your mind from automatically linking the current trade setup to the outcomes of past trades.
Because you fully accept that this trade's outcome is fundamentally uncertain.
Exactly. It allows you to have neutral and open-ended expectations about the immediate result. You deeply understand that each now moment in the market is unique.
Even if a chart pattern looks identical to one from yesterday.
Yes, because the people creating that pattern, the buyers and sellers interacting right now, are different. Their intentions, their fears, their capital, it's all different. That makes the context unique, even if the visual looks familiar.
Douglas tells that story about the analyst and the floor trader.
Right. Yeah, the brilliant analyst calls the low perfectly based on his models. But then a big seasoned floor trader just steps in and sells a huge block, 2 million bushels, I think it was.
And completely negates the analyst's prediction.
Instantly, proving that it takes only one other trader to negate what you believe, no matter how smart your analysis is. There are always hidden variables.
So the best traders, they factor in those unknowns, the potential actions of other traders.
They absolutely do. They build it into their thinking. They accept that there are constant, never-ending, unknown hidden variables. Typical traders tend to ignore what they can't see or predict, which is why they often fail to define their risk properly or cut losses quickly. They get blindsided by the unexpected.
Which brings us to thinking in probabilities, like a casino.
Exactly like a casino. Casinos make consistent money from events that are individually completely random. Think about blackjack. The house has maybe a 4.5% edge over the player, roughly.
Tiny edge. And each hand is unpredictable, so how do they guarantee profit?
They understand the micro versus macro paradox. At the micro level, any single hand of blackjack is uncertain. The player could win, the house could win, it's unpredictable.
But at the macro level,
Over thousands, millions of hands, a large enough sample size, the outcome becomes statistically certain and predictable. Their small edge will play out, and they will make a profit.
and professional traders need to adopt that exact same mindset.
That's the goal. Don't try to predict the outcome of this specific trade. Don't obsess about being right every single time. Focus on having an edge, a system that gives you a positive expectancy over time.
And then just execute it. Take every signal that conforms to your edge, regardless of how you feel about it.
Precisely. Increase your sample size. Let the probabilities work in your favor over the long run. Just like the casino plays every hand dealt.
It sounds so logical, but putting it into practice must be the hard part. Douglas mentions that trader, Bob the CTA.
Yeah, Bob's story is a classic cautionary tale. He knew all this stuff intellectually, he understood probabilities, but he couldn't function from that perspective emotionally.
What happened?
He got into a trade, it went against him, slightly challenged his expectation of being right now, and he got angry. He actually got out of the trade early, basically to punish the market for not doing what he wanted immediately.
Oh no.
And then, of course, he had to watch it turn around and run 500 points in his original direction. He knew the probabilities favored staying in, but his emotional need to be right now and his inability to accept uncertainty led to self-sabotage.
Wow, that perfectly illustrates the primary trading paradox Douglas talks about.
It does. Successful traders are rigid in their rules and flexible in their expectations. Bob, like many struggling traders, was doing the exact opposite. Flexible with his rules, but rigid in his expectations for this trade.
So, okay, we see the problem, we see the mindset needed. How do we actually build that mindset? How do we change these deep-seated beliefs? He calls it a mechanical approach.
Yes, a mechanical approach to belief transformation. The
Wow.
idea is you can't just, wish away or destroy an old belief, but you can deactivate it.
Deactivate it. How do,
By systematically drawing the energy out of it and consciously redirecting that energy into building a new, more useful belief that serves your goals better.
like the example of believing in Santa Claus as a kid. The belief isn't destroyed. You still know the concept, but it becomes inactive. It doesn't drive your behavior anymore.
Exactly. The energy has been withdrawn from it. And this is crucial because active beliefs, Douglas says, constantly demand expression, often subconsciously.
So those hidden self-sabotaging beliefs may be feeling unworthy of success, or that making money easily is wrong, stuff often picked up in childhood. They will find ways to mess up your trading if they're still active.
They'll find a way. Unintentional errors, hesitations, breaking rules. It's the belief demanding expression.
This is where self-discipline comes in, but not as a character trait.
Right, not something you're just born with or without. He defines self-discipline very specifically as a mental technique to redirect our focus of attention to the object of our goal or desire when that goal or desire conflicts with some other component belief of our mental environment.
So it's a skill you use to consciously choose where your mental energy goes, especially when there's internal conflict.
Exactly. It's the tool you use to starve the old belief and feed the new one.
He uses his own story about becoming a runner.
Right. Yeah, it's a great illustration. He decided he wanted to be a runner, but his mind immediately threw up all sorts of conflicts, distracting thoughts, reasons not to, physical discomfort. The old beliefs, I'm not athletic, this is hard, were fighting back.
So what did he do?
He used a simple mechanical rule: just run one step farther than the last time. Every single time, no matter how he felt, no matter the distracting thoughts, he focused only on that one simple, objective action.
He kept redirecting his focus, his mental energy, to the action aligned with his goal.
Consistently, willfully. And over time, that consistent redirection of energy built up the new belief, the new identity: I am a runner. It became effortless. The energy shifted from the old conflicting beliefs to the new desired one.
That's a powerful model for how this mental retraining works. It's difficult. It takes conscious effort, but it's achievable through consistent action.
Exactly. And that brings us directly to what Douglas calls the mechanical stage of trader development. This is where you actively, consciously train your mind to think like a top trader.
And the main goal here is to install that core belief. I objectively identify my edges.
Right.
To see the market neutrally, without fear or euphoria clouding your perception.
That's the objective: perceiving opportunity clearly without emotional distortion.
So how does the practice exercise work? What are the steps?
Okay, it's very specific. Step 1. Choose a precise trading system, your edge. Could be based on math, indicators, visual patterns, whatever. The key thing is, it must require no subjective decisions during execution.
Why no subjectivity?
Because the point isn't necessarily to find the world's best system right now. The point is to train your mind to follow objective signals without interference. Subjectivity lets the old fears and beliefs creep back in. So clear, unambiguous buy-sell signals.
Got it. Objective signals only. What's next?
Step 2. Predefine your risk. Before you even think about entering the trade, you know exactly how much it will cost you if it doesn't work out. You set your stop loss definitively.
Like, say, a 4-tick stop on Treasury bond futures, or maybe 1.5 to 2 points on the S&P, a fixed, small amount.
Yes. No wiggle room, no seeing how it goes. The risk is defined up front, every single time.
Okay. Step 3.
Consistent time frame and filters. Stick to one primary time frame for your entry and exit signals. You can use other time frames, but only as objective filters, like maybe only taking trades that align with the longer-term daily trend, again, keeping it mechanical.
Makes sense. What about taking profits?
Step 4. Systematic profit taking, specifically scaling out. Divide your position into, say, thirds or quarters. Then take profits on the first portion at a small, predictable move in your favor, maybe 3 or 4 ticks.
Why do that?
Because it immediately takes risk off the table for part of your position. It creates what Douglas calls risk-free opportunity on the remaining portions. This drastically reduces the panic or urge to grab all profits too soon. It helps you stay in the trade longer with the rest, potentially catching bigger moves.
Ah, clever psychology there, reducing the pressure. Okay, what's the final crucial step?
Step 5. Trade in sample sizes. This is absolutely key for embedding that casino mindset. You commit to taking at least 20 consecutive trades based on your objective edge. No skipping, no second guessing, no deviations.
20 trades minimum. Why that number specifically?
It's about getting a statistically meaningful sample size. It forces you to think in probabilities over a series, not fixate on the outcome of any single trade. Just like the casino doesn't judge its edge based on one spin of the roulette wheel, it also helps you objectively see if your edge is actually working over time or if market conditions have changed and it's losing its effectiveness.
Okay, so choose an objective edge. Define risk first, use consistent time frames filters, scale out profits systematically, and trade a sample size of at least 20.
That's the drill. And importantly, you must expect internal conflict when you do this exercise. Your existing beliefs, the ones causing problems, will fight back.
You'll feel hesitation, distracting thoughts, the urge to break the rule.
Absolutely. That's not a sign you're failing. That's the point. That's the old mental software resisting the reprogramming. Doing the exercise despite those feelings is how you build the new mental pathways, redirecting the energy one disciplined trade at a time.
Wow. What a journey we've covered today from, the limits of just looking at fundamentals or charts.
Right into the deep end of the psychological game, which, as Douglas argues, is where the real consistency lies.
Yeah, it's not about predicting the market perfectly, is it? It's about mastering your own mind, taking that full responsibility, truly accepting risk, understanding how your beliefs shape your reality.
And learning to think in probabilities, like the house. Cold, hard probabilities over a large sample size.
So key takeaways. The market's neutral, just a stream of opportunities.
Mhm.
It's our perception, our beliefs that charge it with emotion.
Right. And those beliefs, often running subconsciously, they really dictate our experience and our bottom line. That unwavering belief in uncertainty and the uniqueness of each moment that's paramount.
And self-discipline isn't some magical trait. It's a technique, a skill you can learn to actively reprogram your own mental software.
Couldn't have said it better myself.
Okay, so here's a final thought, something for you to chew on. If your trading results aren't matching up with your analytical skills, if you know what you should do, but find yourself doing something else, making mistakes, self-sabotaging.
It's probably not the market's fault. It's much more likely to be a hidden conflict inside your own belief system.
So ask yourself,
Hmm.
what specific emotional patterns or reactions keep showing up in your trading? Is it that hesitation just before a perfect entry? Is it the panic that makes you cut a winning trade way too short? What might those reactions be pointing to?
Could it be a subconscious belief about risk being inherently bad? Or about loss being unacceptable? Or maybe even a feeling that you don't really deserve to make money easily?
How could you start maybe using that mechanical exercise as a model to begin deactivating those old unhelpful beliefs
Mm.
and start consciously building the mental framework of a consistently successful trader, one trade at a time?